Sarah Borkson-Keto with NAREITs.com and welcome to Quick Study, a monthly review of REIT market developments. I'm joined today by Brad Case, NAREIT's Senior Vice President for Research and Industry Information. So welcome, Brad.
Thank you, Sarah. It's good to be here.
So Brad, let's start by just having an overview of how the REIT market looked in February.
Well, during February, the real estate market and the broader stock market moved in different directions, and that's normal. The correlation between REITs and the rest of the stock market is quite low, and that generally works to the advantage of REIT investors, giving them a very strong diversification benefit. During February, it worked the opposite direction. The stock market gained more than 5% on the month. The REIT market was down 2.75% on the month. That doesn't worry me very much in the context of a longer bull market. It's very normal to have negative months during a bull market. But in fact, only about 2 out of every 3 months during a bull market cycle are positive months. 1/3 of the time you see negative months, and what really matters is the longer term. Even since the beginning of the month, even counting February, REIT investors are ahead of stock market investors. The S&P 500 has been up 2.57% during the year, whereas REIT investors have seen gains of 2.87%.
And were there any sectors that particularly stood out to you during the month?
Well, as I said, it was a tough month for nearly all of the REIT market. The only segment of the equity REIT industry that was positive was infrastructure REITs, up more than 1% on the month. But the other segment of the market that did well during February was mortgage REITs, especially REITs that provide commercial mortgage financing. They were up during the month of February, and they still have a very, very strong dividend yield, as do equity REITs.
And Brad, as you weigh all the different fundamentals, how do you think on balance things look for the rest of the year?
Well, investors should really think not so much in terms of months or quarters or years, but market cycles. And the real estate market cycle has tended to be a quite long one, close to 18 years, and that's something that we've seen since the 1930s. It's about 8 years now since the beginning of this market cycle. So if this market cycle is like previous ones, we're still in the early game. But more importantly, what investors should look to is what's happening in construction markets. Because what we see in construction markets is still very, very low levels of construction, not even back to the levels that we would think of as normal in a growing economy. And so investors should pay attention to construction activity and also vacancy rates. Vacancy rates are still very, very low. And in the multifamily vacancy rate, they essentially can't go any lower. In other property types, they're continuing to go down, and all of that provides confidence for REIT investors that there's still a long way to play out in this commercial real estate market cycle.
Thanks for your insight, Brad.
It's a pleasure.
And for more news and analysis on all things REIT, be sure to visit REIT.com.